We're going to be talking about the operating section of the statement of cash flows now. Here you can see the statement of cash flows we've been looking at. This is Southwest Airlines. And we have operating, investing, and financing. And in this particular video, I'm going to talk about operating method. There it is. So as I said before, there are basically the operating activities are similar to the income statement. This is called, by the way, a direct method operating activity section. There's also going to be something called an indirect method. The direct method is actually optional. And what it looks like is kind of like an income statement, except that the cash inflows and outflows are cash inflows and outflows. It's not revenues and cost of goods sold and expenses and things like that, meaning that they're measured when the cash flow takes place rather than when the revenue is earned or when an expense is matched up to a revenue. So for example, instead of revenue on the income statement in the operating section, we're going to have cash from customers. That's like revenue, but it's the cash measure. Instead of cost of goods sold, we have cash paid to suppliers. And that's kind of similar to cost of goods sold. Instead of salary expense, we have cash paid to employees. Instead of interest expense, we have interest paid. And instead of interest and dividend revenue, I have cash received from interest and dividends. Instead of selling general and administrative expenses, I have other operating cash payments. And this is called the direct method. The other thing to know about this is, while it's similar to the income statement, on the balance sheet, it kind of impacts current assets and current liabilities. Just like I said previously, the investing section impacts what? The non-current asset section of the balance sheet, and the financing section has everything to do with long-term debt and stockholders' equity. Well, operating activities relate to current assets and current liabilities because usually when you receive money from customers, that's going to create current assets. If you pay debts, then you may be paying off. If you pay suppliers, you may be paying off accounts payable, which is a current liability. So for now, take a couple minutes and answer questions one. Pause this, answer questions 1 and 2, and then continue. So now that you paused, remember that operating activities include cash transactions that primarily affect current assets and current liabilities. And now let's go through transactions that are recorded in the operating section of the statement of cash flows. Receive cash from customers paying on account. That's going to be operating. The next thing, pay rent for the next accounting period, is also going to be operating cash flow. Receive the utility bill for this accounting period that will be paid next accounting period is not a cash flow because you're not making any payment. Extend $100,000 of credit to supplier Barry so they can make a purchase. So supplier Barry is buying something from you, and rather than paying you now, you're extending them $100,000 worth of credit. That's not a cash flow because you're not actually receiving any money. But when you receive an interest payment of $8,000, that will be an operating cash flow, even though it's interest, because cash from interest and dividends, as we said before, is an operating cash flow. Supplier Barry pays off the $100,000. That's also an operating cash flow. Now, this is called the direct method. The other method that you may see is called the indirect method. And the indirect method is required. So the direct method is actually optional, and very few companies use it. But the indirect method is required, and all companies use it. So for example, for Southwest Airlines, this is the indirect method. And the way the indirect method works is it starts off with net income, and then it ends up with net cash flows from operating activities. And it explains all the difference. And this is important because a lot of times there's a big difference. If you look at Southwest income in 2011 is less than half of their income in 2010. However, their cash flows is 6 or 7 times that, $1.385 billion. So it's natural to ask as an investor, why is cash from operating activities, why is the company's cash flow so much higher than net income? Why is there such a big difference? And in fact, this is very good. The fact that the company had a reduction in income, but the cash flow remains very high, is a sign that the company is actually doing quite well, even though the profitability is down. So we would look at this and understand what's going on, what's driving this difference. And the primary driver here is, the biggest item is depreciation expense. Now, the reason why we add depreciation expense, it's not intuitive to add depreciation expense here. The reason why we add depreciation expense is because when we calculated net income, we subtracted depreciation expense, but we didn't pay for it. When you're calculating net income, one expense is depreciation expense, but it's not an expense you have to pay for. Therefore, we can add it back to net income to determine what cash flows are. So even though we only had $178 million in income, one expense in arriving at that income was depreciation expense, $715 million. We didn't pay depreciation expense because you don't pay for depreciation expense. All the depreciation expense is the distribution of the cost of a long-lived asset over the periods benefited from that asset. That's all it is, but it's not actually paid for. The payment occurs when you buy the asset. That's an investing activity. Anyway, so we add back depreciation. So immediately, Southwest cash flows are actually much better than you think, and they're $903 million. Another item here is an increase in accounts receivable. The reason why I say it's an increase is because it's in parentheses. An increase in accounts receivable, and that's subtracted. Why? Because if accounts receivable went up, that means that instead of collecting $26 million more, we made sales which we didn't collect, an additional sales of $26 million that we didn't collect, and that hurts our cash flow. Now, if it had been a decrease in accounts receivable, it would have been added, because a decrease in accounts receivable means that we collected more money than we sold. We not only collected all the money from our sales, let's say, but accounts receivable went down, i.e. we collected some accounts receivable. Increase in other, here you have a decrease in other current assets, and that's similar to a decrease in accounts receivable. If you decrease other current assets, then you're creating liquidity for the company. So it tends to be that increases in current assets soak up your liquidity. If you had a big increase in, let's say, inventory, well, you had to pay for that. So an increase in inventory, which is another current asset, would soak up your cash flow and therefore would have to be subtracted. If you had a decrease in inventory, that would create cash flow for you because you're selling things and not replacing them. And therefore, the decrease in inventory would be added. We also have an increase in payables of $253. What happened was that liabilities went up by $253. This is like not paying your credit card bill, which you should never do, by the way. You should always pay your credit card bill. But it's like not paying your credit card bill. If you don't pay your credit card bill, the liability goes up and your cash flow goes up too, because you have money that you usually spend to pay your bill. So an increase in payables would improve your cash flow because you're not paying your debts as fast. On the other hand, a decrease in payables would be subtracted because to pay off your liabilities faster, it's going to soak up your cash flow. That's going to hurt your cash flow. And there's other items here of 200. So that tells you the story. What seems to be happening here is that not only do they have depreciation expense, but they're paying their bills a little more slowly, i.e. payables are increasing. And therefore, their cash flow is better. The next thing to do now is to pause the video and complete questions 3 through 6. Great job. So now, cash flows from operating activities here is reported using the indirect method. The strongest year for Southwest Airlines was, and I said 2010. Why? Because they had the highest net income and cash flows. The weakest year for Southwest was 2009 because they had the lowest income and the lowest cash flow. And Southwest Airlines, if you look it up in the book, it operates only Boeing aircraft. And the reason why is to reduce operating costs. So by having only one kind of plane that they use, that reduces the cost of maintaining their planes because they only need to know how to maintain one type of aircraft.